Hello. So good morning, everyone. I think we can get started with this session. It's a bit delayed, but it's fine. We had to fix some signals outside, but we start to have some good number of people. So good morning. My name is Francisco Velázquez, and I am the president of one of the longest history venture capital firms in Southern Europe. We invest in Latin America, in Europe, and in Asia. And I'm here to talk about how to stimulate the equity market in Europe to finance startups. Basically, what I'm going to talk about is how to stimulate venture capital, which is basically the backbone for the investments in technology and innovation in everywhere in the world, not only in Europe. And therefore, all the session will be around how to stimulate venture capital. We'll go through the situation today of the market in Europe, and then we'll try to understand why there's a gap between Europe and the rest of the large hubs or large macro continents, which are the US and China, why we have this gap, and how it can be resolved. So this is basically the whole process of flow of thoughts of the presentation. There are several slides with some data. I will try to pass them quickly, but I thought it was good for you to have the data as well. And then we can do a session for Q&A at the end. Okay? All the presentation will be available for you on the internet, so you can as well look through it. So first of all, the important thing to understand is that venture capital it's a world-class asset and is behind most of the largest companies in the world. Of course, this everyone knows, but when you go down the stream, you can see that all the great companies that are happening in the world and that are creating value, they are all coming from, most of them are coming from a VC backed. And that's the reason why we have to concentrate on the VC industry, the venture capital industry, to understand the flow of money and investment into research and development. When I say it's an asset class, it's because many people still believe, especially in Europe, that venture capital is kind of an experiment. Experimental phase or something that some geeks or some engineers do. The reality is very different from that. At the moment, there are almost 700 billion invested in venture capital worldwide. It's the second asset class after buyout, which is the largest, but not so much larger than venture, and is therefore a significant asset class for all the kind of investors, not only for experimental phases. And this is very important to understand, that we are talking about something that is in the industry of financial markets as any other asset class. In Europe, the evolution of venture capital, as you can see in the chart, has been growing steadily in the last 5 years. And we have created a lot of great companies out of Europe. For example, last year, we beat the US for the first time in history in IPOs by tech companies, in amount of money of those IPOs. And this is quite an achievement. You can see companies like Spotify, IDN, who are world-class leaders in their sectors. They are not just European leaders, they are world-class. They are leaders in the US as well. And this is the first time this thing is happening, but it's happening now, and it's very important to understand as well. So the venture capital in Europe is growing well. There's another thing that is very interesting, which is a main breakthrough in the industry as well, and is that 80% of the venture capitalists in Europe have already more than 10 years of experience. That means that maybe 10 years ago, we could talk about this asset class in Europe, but there were no agents really with track record to invest. Now there are more than 200 that we have mapped out. We are as well fund-of-fund investors, so we invest in venture capital firms as well. And we have mapped out more than 200 in Europe with more than 10 years and a huge track record. This is as well a breakthrough in the European market that is showing this inflection point, the turnaround point in the industry. One of the main reasons this is as well building in Europe is because European market is large. We know that. There is a huge talent pool, and this is not because we are European, we have to say, But the reality is that when you look at the European market and the shift that the society has taken through entrepreneurship is quite astonishing since the financial crisis in 2008. Of course, in the US, they already had that entrepreneurial spirit, so they did not have to go through that process. But we went through that process in the last 10 years, and that's showing as well a lot of momentum in the industry. And this is why venture capitalists will continue to invest and invest more in innovation and research. You can see here some polls from the university, especially, where students are changing their mindset of what they want to do in the future. More and more students want to become entrepreneurs rather than working for corporations or for public agencies. And this is a shift that happens in all of the countries in Europe, even in the Southern European ones, which are normally a bit behind on this. On the talent pool, which I was telling before, of the 10th best computer science institutions in the world, 5 are European. On the developer side, you have hubs like London that are already as large as San Francisco and with a lower cost. And when you talk to STEM graduates or engineers and science students, the amount that Europe produces is twice as large as the US one. So the reality is that despite sometimes the gloomy messages that we receive, in Europe we have a very large market, and entrepreneurial mindset has changed completely in the last 10 years, and we have a lot of engineers that are coming through the best universities. So this is basically the matter in which we work as VCs. However, and this is what I'm going to talk about here now, there's still a big gap in investment when you compare to the US. So even though the market is large, the venture capital industry has been developed, there's still a huge gap when you compare it to the US. It's about 4 to 1, 5 to 1. The same thing happens when you compare it to China. And where is the gap coming from? The gap is coming from mainly from long-term financial investors, which basically are the institutions like pension funds and insurance companies that are the largest investors in any asset class in the world because they are the owners of the savings of the people. So at the end of the day, and when you look at where the gap is, mostly is coming from pension funds. As you can see, in the US, the government agencies continue to invest a lot in innovation and research. So no one should think that the US is not investing in this. It's investing more than Europe. But there is not a gap there. The big gap is here, and is where the real money is. And the other major problem that we see is that the appetite is still low. When you go to the left-hand side of the chart, you'll see that the appetite for European investors in the private equity as a whole, and when you go to VC, the difference is even larger, is less than in the US and China. And we'll see later why this is. What we did to understand that is we ran a survey. And I'm going to talk about this in the last part of my presentation. We ran a survey with about 60 participants from the pension fund and the insurance industry in Europe, to understand why they were not investing in venture capital, why there's such a reluctance in this asset class that we have already shown that produces results and that has a stable market already. They gave us 6 reasons. First, 2 are related to returns. They believe the returns in venture capital are low as a whole. It's like a risk-adverse view. And they believe that if they had to do something, they could do it in the US. That's one of the things they say. Then they say the venture capital is very risky. We'll go through that later. And then they start to talk about the limitations they have. The tickets the funds are too small. They have to put small tickets. They don't have teams. And the final thing is about regulation, which is something which is very special in Europe, where we have an over-regulation through Basilea and solvency. And we'll go through those 6 now, and then I'll give you some recommendations, and we can go through the Q&A session. Let's go back to this one. Of these 6 reasons that they provided to us, the first 2 are wrong. I'll show you now why. And the other 5 are, the other 4 which are really are 5, are treated. They can be treated and can be resolved. The first 2 are wrong for the and the historic data is there. No, when you look at the returns in the industry, private equity as a whole, which is, remember, something they do not have appetite for as a whole, private equity, not only venture capital, is the best asset class by far in the world. And this is steady analysis. When you go back in 10, 30, 50 years, it's always the same. It's the best asset class in average returns. And when you look to buyout and you compare it to VC, which is one of the things that our respondents told us, you can see that the venture capital normally is performing as the buyout or better. So venture capital as an asset class is one of the best performing asset class in the world in a sustainable manner. And this is a historical data that you can track down as many years as you want. You will always get the same result. The other thing is European versus China or the US. They say, okay, you convinced me with venture, but I think I should do it in the US. But the reality is that in the last 5 years, the venture capital in Europe has provided average returns that are better than the US and the Chinese market, basically because of the inherent potential of the European market that I have shown before, and also because there is a gap of financing, which makes the companies be worth less, have lower valuations, and therefore create more value for investors. And you can see here that this is an analysis which is 5 years back. It's coming from real flows of money. So this is not data that people put in. It's data coming from the cash flows from investors. You can see that the returns in Europe, the dark one, are larger than in the US in all of the different years, and in overall are similar to China. Even in most of the latest years, is even better than China, considering that people have a lot of difficulties in investing in China unless they are Chinese. But the important thing is the one on the right. The one on the right shows the distributions. So not the value created on unrealized money, so money that is on companies, but really the money that is given back to investors. The European one is much, much larger than any of the other regions. So, so from an investor's point of view, it's generating returns and it's providing money back. So basically, it's not a good claim to say that the venture capital is not good or the European venture capital is worse than the American and the Chinese. And this is what we are trying to show to our investors in our new fund of fund projects in Europe. We're trying to make them understand that they have to be here because it makes a lot of sense, statistically speaking. One of the other problems that they have is, which I was talking before, is that they told us is very risky. Okay, venture capital is risky. And it's true. It's a risky asset. As you can see here, when you invest in one company, you go to the dark curve. And basically what we are saying here is, based on the amount of funds that you invest or you put together, how it outperforms the Standard & Poor's 500. This is based on real flows, 30-year cash flows of 3,000 investors. You will see that truly there is a risk. So if you invest in one fund, you can lose a lot or you can win a lot. But the reality is that large institutions have a lot of money. They can diversify by investing in X amount of funds. In the very moment you invest in more than 15 funds as an asset class, you go to this curve, and 30 would be this gray curve. You completely remove almost completely remove the risk of being below the SP 500 as an average return, which means that if you are a financial investor and you have enough money to invest, which is what happens to all of the pension funds or insurance companies in Europe, it's just a matter of diversifying your portfolio, and then you get rid of that problem. So that is workable by the diversification, and I'll show you later a few recommendations to do that, which we are trying to promote as well as investors in fund of funds. There is one real issue, and it's the size of the European venture capital funds compared to the American or the Chinese one. And this issue is going to stay there for long, because the European market is scattered, it's based on different countries, and you have to have local players and regional players. So the funding size is always going to be smaller. But in any case, and what is the problem with this? The problem is that if you're a 10, 20, 100 billion pension fund, and you have to allocate resources, you cannot do small tickets. You have to put 20, 25 at least per investment, right? If the fund is too small, it's very difficult to put that such investments into a fund. But the reality, and that is true, it's a real claim. There are ways to work it out. If you invest in fund of funds, they do it for you. So you can put a ticket of 50 million in a fund of fund, and they will do that for you by diversifying. But in any case, it's understandable, it's an issue. But the reality is the average and median size of the venture capital funds is growing. It's already close to 160 million euros. It's lower than the American, but it's not so lower. And at that type of average size, you can get already a lot, or if not most, of the pension funds in Europe in. So it is an issue. It can be resolved, and it's becoming less and less of an issue as the years come, because the funds are getting larger in size. So I don't think that will be a problem. The other thing that they mentioned, and it's true as well, is that they don't have expertise in venture capital. This is a really problem in the industry. Most of our pension funds in Europe and insurance companies do not have specialized venture capital teams. And without that, it's impossible to follow an asset class. So they have fixed income, they have equities, real estate, special situations, buyout, but they don't have venture capital. And some of them are building it. When you have large amounts to invest, you can afford to build teams. And some others use fund of funds to do that. But in any case, this is an issue which we need to resolve, or these investors need to resolve, which is having teams and people to analyze the investments. Last thing is regulation. Regulation was not, surprisingly for us, was not the #1 issue they mentioned. So it was, the #1 issue was the returns. So the perception they have on returns and risk, which I talked about already. But they always talk about regulation, because after the crisis with the Basilea and solvency programs, which are now even introducing new versions which are more restrictive, the consumption of capital of any alternative investment, especially technology one, is so high that it penalizes a lot the investment, the use of the balance sheet by the pension funds and insurance companies. That means that, for example, if they invest right now in a venture capital firm, they have to provision 250% of that in equity. Where if they invested in bonds in Greece or in Argentina or in Spain or in whatever, that would not penalize them at all. When the risk probably, when you have a diversification program, is very similar. So there is a mismatch between what the regulators are asking and the reality of the asset class. But this is an issue, and it's not the largest issue, by the way, but it's an issue. The other one is the Eureka passport. For those who don't know the industry very well, when you are doing fundraising, you need to have a passport. You need to have a license to fundraise. And in Europe, you need to do a Eureka passport for each of the countries. And that Eureka passport, which should be useful, I mean, which is a very good idea, it is really not practical, because all of the different countries have their own regulators, and you have to go through the regulators. So what happens is that most of the VCs cannot market their funds outside of their own countries. And this is a real problem, because you cannot use private banking networks. You cannot go and pitch pension funds in Finland if you are Spanish, and vice versa. So it becomes a hurdle, which can be overcome and is improving. There are very good movements in trying to improve this, but still it's a hurdle. On the positive side, there are very good tax programs for investments in innovation, which is something that helps as well investors to come in. So as you can see, here we do a summary. Trying to understand why institutional investors are not promoting venture capital, which is the essential backbone of innovation and research in terms of investments. We see that there are 7 main issues, of which 2 of them are perception problems. They are not real. It's just inertia that our big investors have in Europe. And the other 5 are workable. Return dispersion can be worked out with diversification, either via fund of funds or directly. Minimum ticket size is an issue, but again, you can use fund of fund programs to resolve that problem. Dedicated teams, again, is an issue, but depending on the size of the investment of the investor, they can just build it themselves, or again use fund-of-fund programs to use the teams that the fund-of-fund companies have to do the allocation of the funding. And then the regulatory problems, which are not the biggest ones, the bigger ones. I mean, they are not really the bigger issues. They are being resolved, and in any case, with today's interest rates and the charges that these large investors have in the current accounts just for having frozen money, it really pays off for them to have the investments, working and producing returns, even with the regulatory burdens. So I don't see that, although we have to work on that front, we don't see that as being the major challenge. On the recommendations, on the first, let's say, the first 3 risk-related issues, the only way to work through that is by dissemination of results. For example, one of the things that we are doing, we are one of the Venture EU awarded companies for fund of funds program in Europe. One of the things that we are doing is disseminating all this information to investors to try to make them understand that the asset class is very good and that the risk is workable through diversification. And then, of course, trying to put together managers with institutions. It's amazing the lack of knowledge that large institutions who manage billions, hundreds of billions in some cases of money, have the lack of knowledge they have on an asset class, which is one of the best asset classes in the world, and is a very large asset class on its own. So the only way is to disseminate, have more programs, more people pitching these institutions. On the other issues, on the support from the public sector and the regulation, we believe that the European Commission has made a very good effort with the Venture EU program, and now the new programs that are coming, I'm sure, are going to be even better. What the investors always want to take the first steps is to have some kind of incentive to do it. The ways to incentivize is to provide leverage, for example, public-private leverage, which is something that I know the European Commission is working on. Provide some kind of risk reduction programs. For example, they do it in the US a lot. The public money receives up to a certain hurdle, a certain return. For example, if the fund produces a 12% return, up to 6% is received by the public funding, and then from the 6 to the 12 is provided back to investors, which makes an improvement on the investors' IRR. This is a very typical program that the Americans use for their own VCs and their own innovation financing programs. And on the regulation side, it's just a matter of continue working with whoever does the regulation at the European Commission level to try to put special treatments on innovation investments so that they don't penalize so much. And sometimes there's a big asymmetry between that penalty and the reality to the venture capital assets. And this is basically all the flow of the process that I wanted to go through with you to explain, that first of all, as a summary, that the venture is really the backbone of everything. So without the venture capital industry, it's impossible to develop technology and innovation everywhere in the world. The Americans know this very well. They have been promoting it since 50 years now. But it needs private money because it's where the real money is, the real amounts of money are. To do that, we have to incentivize or to promote this kind of investments with pension funds and insurance companies, who are the real owners of the savings. And to do that, I showed a couple of issues and how they can be solved. We are very positive because we see in our own experience in this first fund of fund that we launched 1 year ago that more and more pension funds and insurance companies are buying this message and they are getting into it, but the amounts they are investing, they are still very small compared to the amounts they really have. So there's a huge amount of way to go, as big as this one. So this is the way to go that we still have. So we still have to multiply by probably 10 times, 11 times, I think. I don't have the number, but it's 11 times the difference between what the Americans are investing, private investors, private institutions, compared to European ones. That 11-to-1 ratio makes everything, makes all the difference. And this is what we are trying to work. So now, open for any questions from the audience.
How much in... Thank you very much. Congratulations for a great presentation. I would just like to ask a question. How much is this in money, approximately, in US? I'm speaking about the boost from e.g. 6 to 12%, this 6% that US government provide as a grant or a subsidy. How much would this be if mentioned in a figure? How many billions or trillion per annum?
Yeah, if I'm not mistaken, public institutions in the US are about 40 billion per year investing in different programs, all different kinds of programs, grants, financing to venture, to funds. Yeah, about that. I don't have, I mean, I have the number, but I don't remember by heart, but it's about 40 billion. It's like 25% higher than what we have in Europe, according to our numbers. Yeah. Any other question?
Hi. Hi, sorry. I'm at the back here, sorry. I'm very curious. First of all, thank you for the presentation. It's very interesting. Just maybe your personal opinion, or I'm very interested to know why the returns have been higher for the European VC market compared to the US market. Is it because the US VC market is just investing in whatever it finds, or is it because the European VCs are a bit more stringent in their requirements or in their selection of investment opportunities? So I'm very curious to know how the European market, as in for investors, has outperformed the ones for the American investors.
Yeah. Well, it's not so easy to provide an answer to that, because I give you my educated guess. There are two reasons that are, for me, are very obvious. One is there is a funding gap in Europe, and therefore the valuations for the same kind of companies are lower. And if the valuations are lower, you have more room for generating value. So it's true that when we close the gap, if that gap is closed ever, that won't be a difference. The other one is the use of resources. The companies in Europe are much more efficient in using resources because salaries, basically because of this. Let me see. Because you have, in the US, you have a big glut in talent, and talent is very expensive. The average salary of a developer in San Francisco is $150,000. And the largest salary in Europe, which is in London, for a developer is £60,000. So the use of resources is very efficient compared to the American one, because we have more talent available. They have to import all the talent from China, from India, from Europe, and it's expensive. So those are the two reasons. 10 million in Europe buy you much more time than 10 million in the US, and that at the end of the day becomes more value generated for investors. Those are the two main reasons.
Yes, thank you. Looking at the company, I mean, the SMEs, the small new ventures, new companies, newcos in Europe, do you see any difference? I mean, the feeling is that, it's easier for a startup to get money in the States than get it in Europe. Is there a problem, let's say, in the interface between your industry and let's say the company base in Europe? Should be more instruments to help you to screen and get in touch with potential companies that have potential investment from venture capitalists? Is there a problem there? Perhaps this dissemination, perhaps the size, I don't know.
Well, there is one thing we need to understand about Europe. of course, that all of you understand, but I will just put an emphasis on that, what makes it different. At the end of the day, in the US, you have a bunch of big investors in Silicon Valley and New York and Boston, and they really take the bulk of it. Most of them, the others are useless, so to speak. And in fact, they produce very low returns. So the American VC is super skewed. So there are a few of them that make money, all of them lose. All the rest. In Europe, you need to have local players. So if you want to go, you want to invest in France, even if you are a pan-regional player, you have to really invest with local players who add close to the hubs. If you do it in the Netherlands, the same. So the major problem that we have at the moment is not with the larger funds, because in Europe the pan-regional funds are starting to grow and they are starting to be big, and they invest globally, is with the small ones. And I think this is where when you identify that problem that exists, is true, is because the smaller funds in any of the countries in Europe are lower than 100 million, and they do not have a lot of support from institutional investors because they are too small. And that makes them being more risk adverse. But I think that is changing. We see more and more incubation, startup, or early stage funds that are succeeding with third, fourth fund, with local support. They still have a lot of EIF support or local funding. For example, in France you have BBI, in Spain you have the Fondico, BBB in the UK, and everywhere you have something. So that is going to change. It's changing. I see a change, but it's true that it's more difficult and it's tougher for deep tech, especially, and for very early stage companies, especially coming from universities, to get funded than in the US, because the funds at that stage they still are having this problem, but the problem is being solved. I don't think there is a lot to be done, but to continue promoting those kind of companies, especially with the EIF and all the programs that they need public funding still, and it's necessary. You have a question? No? Yes.
One of your recommendations was regarding public intervention. Can you tell more about how the public, in a rational way, can lift risk off these investors to make it a more viable asset class?
Yeah. I have seen several ideas, several implementations, especially in the US. But I saw them as well, especially in Spain a few years ago. The way to do it is that, for example, if you have a contribution from a public institution, the EIF, or any of these BPIs, Fondico, the local fund of fund programs, they put a cap on the return that they want to achieve, but they bear the same amount of losses pro rata to their participation if there are losses. So the effect is that if there is an excess of return on top of the cap that you have put, that excess goes to the private investors. And that's a very good incentive, because imagine that I have invested in a fund and it produces a 15% return, which is on the average, we are seeing net 15, 17% return to investors, especially in the top tier. And the public funding is capped at 6%, for example. That 6% to 15, which is a big chunk, produces a multiplier effect on the return of the investor. So the investor instead of receiving 15% receives 25 or 30%, and the public funding is capped at 6%. That is a fantastic way to incentivize. The other one is to guarantee the losses, but I think that I have seen it less, and I think it's more unfair. And obviously that when you talk to investors, that is what they would like, that someone puts a guarantee on the losses. Especially, why? Because institutional investors, they don't care about getting 15 or 20%. They just want to get 6 or 8 or 4 and have very little troubles. So they always prefer to limit the risk than to elevate the upside. But both ways, especially elevating the upside, which I think is more fair, work. They work, and we have seen investors in our third fund in Spain. We received investment from Fondico, and they had a cap of 12%, which then was removed because state aid, and in the future funds they were not able to do it. But we have it. We have it in our regulation for the third fund, and when the fund passes 12%, we can purchase the shares at that price, and we make money on the excess. And the investors like that a lot.
Hi, thank you very much for the presentation. I come from Cambridge in the UK, and we often see that the startups that we create in that cluster tend to exit to companies often owned by US-based multinationals. Do you think that the fact that there are a lot of exits happening to US companies rather than listings on European exchanges is in itself creating a big bias in the nature of VC development in the two continents?
Yeah. The other contributor, which I have not concentrated too much here, and this is a very, very good question, thank you, are the corporates. Not as investors, which they are as well, and in Europe we have a lot of corporates investing in funds, but as exit providers, and I understand your logic. I think that in the same manner, institutional investors in Europe have to learn how to deal with the venture capital and the technology industry, which makes a lot of sense to them. It's just a matter of starting with it. Corporates have the same issue. I think the American corporations have more intrinsic values in their own organizations about technology and innovation as a barrier in the long run for their own businesses. But I think that is changing. We see, I don't have here a presentation about that, but I can show you numbers, and that the corporate VC in Europe is growing a lot, and they're providing a lot of exits. So there is a skew, it's true, and there are some technological companies that are very cash rich, Amazon, Google, and all those that are American. But then when you go to industries like biotech, life sciences, and other things that are more technology oriented rather than only digital, I see more and more European companies doing that, and especially for example in the Cambridge network, I see as well that thing shifting. It's a matter of time. In that particular thing, you cannot really do anything, but just wait for the whole industry to develop. Any other question, or it's okay? So they tell me we are done with it. Thank you very much for your attention.